Hey traders, Gavin McMaster here from Options Trading IQ, doing another trade review. This time we're looking at a bull put spread on Coin, walk you through how we set up the trade, the challenges that we faced, how we adjusted it, and how we managed to get out of the trade with a nice profit. Just before we do that, a quick reminder that everything discussed is for educational purposes only, is general in nature, and does not take into account your personal circumstances. Okay, so here's our initial trade setup. This was from June 6th. We went with a 15 delta, or actually a 14 delta bull put spread. So with the stock trading up at 250, you can see that 15 or 14 delta was down at 200, so a long way away because the volatility was really high. So when volatility is really high, those 15 delta strikes are much further away. And you can see here we've generated about $180 to $190 in premium. So that's our maximum profit. That's our blue line, is our payoff graph at expiration. And we've got about 810, 820 in maximum loss or capital at risk. And the purple line is our T+0 line. So you can see we're going to make money if the stock rallies. We're going to lose money if the stock falls. And over time, this purple line is going to move upwards towards that blue line, thanks to time decay. Okay, so moving forward to June 24th, the stock's had a pretty big drop. We've dropped down to 221. And the delta on our short strike has blown out to 22. And you can see the premium left in the trade now is at about 250, 260. So we're down about $70 or so. And at this point, I want to adjust. Once you start getting close to the short strike in a bull put spread, they become much harder to adjust. So I like to adjust well before we get to the short strike. Usually when we get to sort of a 20 to 25 delta, that's when I start thinking about adjusting. The stock had put in a pretty big bearish candle, so I wanted to adjust sooner rather than later. If I left it too long, it becomes much harder to adjust. So basically what we're going to do is we're going to roll the puts down. We're going to buy this spread to close. We're going to roll it down to 195, 190. We're going to go to 3 contracts, and then at the same time, we're going to add a single bear call spread up at 290, 300. So this is before the adjustment. You can see about 250, 260 in premium remaining. And then after the adjustment, we've actually increased the amount of premium by going to 1 extra contract on the puts and generating about $70, $65, $70 in premium for adding the bear call spread. We've actually managed to move our short strikes further away and increase the profit potential in the trade. Our delta dollars has dropped slightly, so our notional exposure hasn't really changed. The main thing is we've added a little bit of extra risk on the the downside. We've gone from about 800 capital at risk now to about 1100, 1130. So just to repeat those steps, we buy back the 195, 200 spread, and we open a new spread at 195, 190, and we go to 3 contracts. At the same time, we open a bear call spread 290, 300 for 1 contract. You can see that's very far away on the upside, so it doesn't add a whole lot of risk on the upside, and it just brings in a little bit of extra premium to help generate some more premium and increase the profit potential in the trade without really adding any notional directional risk. The next day, very next day, Coin continued dropping, went all the way down to 213. So again, we're getting a little bit close to that short strike. We're down a bit on the trade. Our delta dollars is getting higher, and the short strike delta has blown through 25. So I want to play a bit of defense in this scenario. I definitely want to roll these puts down further in price. So that's going to be a debit trade. In this case, we're playing defense. It's costing us a little bit of money to make this adjustment. It's reducing the profit potential. So you can see here, there's about $490 in premium remaining. I can't remember exactly how much we were down at this point, maybe $100 or so. What we're going to do is we're going to roll them down from 195, 190 to 190, 185. And we're going to keep the contracts the same at 300. So you'll see the premium remaining in the trade, 490, is going to drop by about $90, which is what it cost us to make that roll. So here we are after. Now we've got $400 in premium remaining, but we've rolled back a little bit further. We're still pretty high with our delta at 23. We've just bought ourselves an extra $5 while we wait for the stock to recover. Then we're able to stay in the trade until about July 2nd. The stock recovered back up to about 230. You can see that premium remaining in the trade has dropped from 400 all the way down to 100. So in this space of about a week or so, we've gained another $300 on the trade, ended up with a profit of about $110 on the trade. Hopefully that little adjustment strategy helps you. If you've got any questions, please reach out anytime. Otherwise, thanks for watching and have a great day.